Hey, good morning and welcome to the third and final session in Your Passport to Passive. Thank you so very much for joining us today. I'm Michelle Knopf from CoreShares, and I've got Deborah Slabber here from Morningstar as my guest host joining me today. I hope you are all staying positive and testing negative this morning. I don't think any of us thought we'd still be in this virtual environment at this stage of the game. I know we're all very bored of sitting in front of our screens, but thank you so much for joining us. It's great to still be able to be together, and hopefully, at some point we'll be able to do this all over a breakfast or a lunch again one day. So I hope people got a coffee and you're settling down for a nice, to listen and discuss with us and just have some time away from your normal day jobs and thinking about tools and tips for the modern financial advisors. So our idea for this whole series was really just to put together some high quality education on passive investing. I think a lot of what's gone before in the industry was a lot of messaging around active versus passive or active or passive. And I think the aim of this series was really to show that, passive investing has some merits and particular benefits, and there's an optimal way to blend that into your portfolio and really just work through what benefits it can bring to your portfolio as just another tool in the toolkit, rather than being this dichotomy of either or. And so the first session we had Chris Rule from CoreShares really just going through the basics of what passive investing is. And then in the second session, Victoria Rivas from Morningstar worked through some really nice examples of how to use passive investing in a portfolio and the reasons to use it. And so today we've got a really interesting lineup. So it's always nicer to hear from your peers rather than hear from the fund providers. So Deborah's got some very experienced IFAs for a panel discussion. And then we'll have plenty of time for Q&A. So just some housekeeping. There is a Q&A function on the Zoom webinar. Please feel free to pop all your questions and comments in there during the session, and we'll have time for those at the end. If you would like CPD points, please stay on until the end, because there'll be a survey as you leave where you can pop in your ID number so that you can get your CPD certificate in the next week or so. So we'll try and wrap up sort of the formal presentations, discussions around 10:45, so that we've got plenty of time for the Q&A at the end. So before I hand over to Deborah and her panel, let me just sort of set the scene of where we are in the discussion. So really, the case for passive can be summed up in a nice visual nutshell. I really like this because it's very visual. So John Bogle, founder of Vanguard, said, "Don't look for a needle in the haystack, just buy the haystack." So yes, there are some people who are good at picking stocks and can outperform, but really, the simplest way to get performance in line with the market is just to buy the whole market. So that's and then the more academic argument behind it is to actually look at the whole universe of active managers and assess their performance compared to a benchmark. So there is S&P index provider, who I'm sure you've all heard of. They run a particular index methodology called SPIVA, which is S&P index versus active. And so they look at groups of active managers versus a benchmark. So this is the data for South African equity managers compared to a benchmark to the end of June 2020. And it's quite a staggering figure, 95% of the managers underperformed a benchmark after fees. So yes, you can still pick the outperformers. You have a 5% chance of doing it. What we really want to look at then is how consistent is this data? Was that a one-off? Was that related to COVID? Was there something particular in that period? Or is this a regular, consistent phenomenon? So we looked at the data going back to December 2014. These are 5-year rolling periods. So looking at the 5 years leading up to December 2014, you will see that 85% of the managers underperformed the benchmark. And so it goes. So over that period, up until the end of 2020, we can see every year it's between 75 and 95% of the managers are underperforming their benchmark. So it's really just showing how hard it is to pick the right active manager. And what this also tells us is why using passive in your portfolio brings some more consistency, because it's almost like picking that really reliable B student. That you're going to get the market performance every time, year after year, and then you can still go and try and pick your active managers around that, but the passive allocation will bring that consistency to your portfolio. And so how does this work in terms of blending this into a portfolio? So this was really explored very thoroughly in the second session, and the recordings are all available on this website where you sign up for this session. So if you want to explore if you missed a previous session and you want to explore these concepts in more detail, please feel free to go and access the recordings in your own time. But this is just one example of how active and passive can work quite nicely in a portfolio blended together. So the example here is the Core Shares Top 50, which has a 20 basis point management fee, so really nice and cheap. And when you blend that into your core of your equity allocation, you're getting market returns. You can still build some active managers around that in the satellite to try and get some outperformance if you have skill in manager selection, like a DFM, like Morningstar would. So this is really where their expertise comes to the table. They build that, they build their asset allocation with nice, cheap core allocations in some cases, like a top 50, and then use their manager selection in the satellite to build in their outperformance. And so what this does, the benefit to the end investors, several points, these little balloons on the right. So you get an average fee that's lower across the portfolio by having that cheap passive core. You're lowering the average fees. You're bringing more consistency, so you're removing some of the lumpiness that you can experience with active managers, and you're bringing more certainty to the long-term goal. So you don't have that risk of that big uncertainty between having picked the top performing active manager and the bottom performing active manager, which can be quite varied. So you're just bringing that more predictability and certainty by having the market returns as a bulk of your allocation. And so why is this helpful to a financial advisor? And bringing it back to why we're all here today is really, I think we can all agree that creating more predictable outcomes and bringing more certainty is really everything that our financial services industry is about, everything from insurance to retirement planning. I think uncertainty is terrifying for all of us, and feeling some reassurance that our lifestyle will be financially viable in the future is really why we're all here. So that being able to bring more certainty to the financial planning is really attractive, and a huge benefit of using some passive allocations. And in addition, the point that I think is worth making is that for financial advisors in these times, I'm sure you've all struggled to keep your clients invested. And this chart is really, it's very colorful, but it's got an important message. It's really trying to show the importance of being diversified across the different asset classes and staying the course. So SA property stands out because it's bright orange, and we all remember the last few years where I think many people have suffered. So we can see in 2018 minus 25%, 2020 minus 34%. The SA property sector's been very badly beaten up. But when we zoom out and look at the whole picture and the longer term picture, going back to 2004, because I think that's just about all we can fit on this crazy chart. I always find it quite surprising to see how frequently SA property was in the top position. So, 5 times it was the top performer, returning as much as 40%, 50%, 30%, 36% in 1 year. So, that long-term view just reminds us that, when one asset class isn't working, another one will be. And that's why it's so important to keep your clients invested in the strategy that's best for them, suited to their goals, their risk appetite, their personal situation, etc. And that's really why we at Core Shares like to partner with financial advisors. We're not one of these passive providers that is recommending that investors try and do it themselves to save money and go direct. We don't have a platform like that for retail investors. We really like to partner with IFAs because we think this is the most important part, is getting your clients into the right asset allocation for their personal situation and then keeping them there. And I think that's the hardest. So what we saw in 2020 at the end of March after the big COVID crash, obviously February and March, huge sell-off globally and locally, over 5 billion Rand was pulled out of SA equity exposures, according to CISA flows. And then what happened in Q2? SA equity returned around 23%. So for the people who panicked during that crash and pulled their money out and sat in cash, they missed out on that recovery rally. And that is really, I mean, we all know how difficult it is to recoup that 23% if you were sitting out of the market. So really the job of IFAs that we really respect and think is so difficult is to keep your clients invested. So we think it's, we like to support IFAs to keep your hands free so that you can focus on doing that important job. And then, helping with these nice, simple passive allocations that can, deliver the exact asset allocation that you want. And with that, I'm going to, and yes, we have plenty of educational resources on our website for further reading, as well as the recordings from the previous session. So with that, I think it's time to hand over to Deborah and her panel of experts so that you can really hear from your peers at, how they're coping with all the challenges that we're experiencing at the moment.
Thank you very much, Michelle. Good morning, ladies and gentlemen. Michelle, thank you so much for the introduction. So thank you so much for that summary on passive investing and how people can incorporate that into their thinking and into their toolkit. Right now, I'm actually going to shift the focus a little bit and talk about the advisor and the role of the modern financial advisor. And I'm saying modern here because we live in this world, and in particular in an industry that has experienced so much change over the last number of years. Whether we think about the amount of information that's available out there, the rise or the come and go of robo-advice, the increase in DFMs, cryptocurrencies, regulation, the list goes on. So there's really a lot to keep up with. And are you as a financial advisor in this day and age sure of what your role entails? Has the role changed over the last number of years? How can you adapt to this changing world, keep up with clients' needs, and then also remain relevant? Luckily, I'm not going to unpack that alone today. I've got two financial advisors with me on the call that I would like to welcome. So Alka, I will start with you. Alka is joining us from Foundation Family Wealth today. She fills many shoes, so she seems like a very busy lady. She's an experienced financial planner. She's an analyst. She's a wealth advisor, and she's one of the directors of Foundation Family Wealth. Then also on my panel today is Quinton Rolfe. Quinton is the founder and the director of Resolute Wealth. Resolute Wealth is also one of the most prestigious financial planning offices in South Africa. And he actually really just specializes in financial and retirement planning for high net worth individuals. So Alka, Quinton, welcome. I know to the audience, both of these panelists look really young, but I promise they do come with a wealth of experience. And I'm really looking forward to unpack the role of the modern financial advisor with you today. So to the audience, remember to post your questions at the bottom of your screen in the Q&A function, and we're going to try and address some of that today. Fantastic. So let's, without further ado, I'm going to give each of my panelists actually just a quick chance to introduce themselves and their businesses to the guys on the call. So let me start with a lady. Alka.
Hi, thanks, Deborah. Thanks. Nice to be here this morning with everyone. My name is Alka Zeki. I'm a co-founder of Foundation Family Wealth. We have a small team of 7, four of which are financial planners. We have just over 2 billion under management, and that is made up of roughly 150 families. So we have a very low client to advisor ratio, and as we grow, we would like to keep it that way if we can, because those personal relationships are really important to us. Our clients are predominantly made up of families, in some cases up to 3 generations, professionals, entrepreneurs, retirees, and we also have not necessarily it was never necessarily a specific focus for us, but we have a lot of experience working with women, and particularly women that have gone through divorce or the death of a spouse. So yeah, I suppose just to end off, you know, we are a holistic financial planning business. For most of our clients, we manage all their assets. And for us, what's really important is to try and help our clients live meaningful lives with the money that they've got.
Thanks so much, Elke. Quentin?
Thank you, and good morning to everybody. To Deborah and Michelle, thank you for allowing us the opportunity to participate in this webinar. And yes, I'd like to think I'm still young at 48 years of age, but I do have 24 years of experience. I think I was just lucky to be given the opportunity to start in this industry at a young age back in 1997. So from our side, Resolute Wealth was founded in 2004. We launched our CAT 2 business in 2017. From an asset management perspective, we manage 3 billion rands of clients' assets. Unlike Elke, and I prefer that model, we actually have a lot of clients. We've got 3 billion, we've probably got close to 1,500 clients. And I think it came from back in the day as advisors, you try and take on as many clients as you can because you're starting out with nothing really. So different model, and so from a staff complement, we've got 18 staff members. Of those, we've got 7 financial advisors, 1 paraplanner, and 1 dedicated analyst. And then from a model portfolio perspective, I'd like to think one of the early adopters. We launched model portfolios back in the day 10 years ago, and we partnered with Morningstar 7 years ago, and both the model portfolios and dealing with Morningstar has really modernized our business and actually enabled us to manage our business a lot more professionally. But we do have a large client base, all walks of life, from small clients to large clients. That's a little about us.
Thank you so much, Quentin. So let's delve into the reason why we're actually here, and thank you so much, CoreShares, for that invitation. So let's talk a little bit about passive investing. And I want to understand from you, and maybe Quentin, this is one for you, is you've mentioned model portfolios and you've actually been running them. It's been 10 years in the making now. How do you see passives as part of a client's portfolio?
Yeah, it's interesting, and it's quite strange. I mean, this industry has evolved dramatically over my 24 years of doing this, and I was quite sort of apprehensive actually going the model portfolio route. And you know, Vicky used to talk to me many years ago, and we sort of looked at different options. And when we decided to go the model portfolio route, the main reason was just efficiencies, actually just being able to manage clients, because with a large client base, and I said, like, you know, I think the sort of perfect situation is having a large sort of asset management business with assets under management, both with fewer families and clients. We sort of not that business. We've got a lot of clients, and we continue to attract a lot of clients, be it small clients. So going the model portfolio route was the only way we could actually manage clients efficiently, to have these model portfolios. And typically when we launch the model portfolios, I mean, we've evolved a lot. We typically used sort of balance type funds, and it was typically always everybody knows the name, so it was always the big sort of like 4 or 5 companies that everybody used, and that was really the construction of the model portfolio in its early days. But going over time and sort of as we've evolved, you know, and just looking at numbers, and it's simply sort of a best of breed approach. Again, Morningstar kept on knocking the door saying, okay, you've done the model portfolios for years, they're working well, but from a performance perspective and a cost perspective, we need to look at sort of relooking and going to a building block approach. And I was typically, and I'm a prime example, I don't like change. I was a little bit sort of hesitant to go the whole passive route. Typically, I do still believe in active management, and I've always sort of said, well, there's value in that, and hopefully we can choose those top 5% fund managers. But sort of looking at the benefits of bringing in passives, and the sort of the low cost of transparency, and you get the performance the bulk of the time, it made absolute sense. So we brought passives into the portfolio. We did swap to a building block approach, and I must say it was a complete game changer. So from a passive perspective, we run 11 portfolios. Of that, we have 4 local portfolios that use passives and 3 offshore portfolios that use passives, and they typically make up 10 to 15% as a core holding. And what that has really given us is it's given us market performance at a low cost. which has really enhanced our portfolios. And then we've tweaked around that with your sort of like top performing active managers. And I mentioned like Fair Tree, which has been an absolute star in our portfolio.
Thanks, Quentin. You mentioned quite a lot of the benefits of having a passive as part of that portfolio construction. So, and a couple of weeks ago when we listened to Vicky as well, she unpacked that as well. And a lot of that, and it came through in your answer as well, is around transparency. It's around the low cost. It's around that predictability element. It's around diversification in a portfolio. So Elke, if you think about all those benefits, which one matters the most to you?
Yeah, it's difficult. I think it's driven a lot by your clients. So same as Quentin, you know, we've also traditionally been using a lot of active solutions, but over the years it's changed a lot, and locally and globally we now offer our clients active and passive solutions. And I think that shift has mainly been driven by our clients. I think from our side, you know, the biggest reason for that being driven by cost. We like including it from a diversification point of view. I think it's a really easy and simple way to diversify investments. So in many cases, we actually blend the solutions. It really depends on the clients and their needs. But I'd say driven by the clients, it's very much driven by costs.
And do you think, saying that it's driven by clients, do you think clients have become over the last couple of years more fee sensitive? That's a trend that we kept on seeing. So I want to hear it from mouth. Or are the clients?
Yes, I think so. I do think so. I think other than the last few months, our markets have been really weak performer. You know, the local market's been a really weak performer for many years actually. And I think you know, passives have been really popular globally, but over the last few years, I think also because of the lower performance, I think South Africans have become much more aware of the solutions and much more focused on the fees. I think the whole narrative is changing a bit.
Okay. And
if I could, sorry, man, if I could interrupt there, and I apologize. I think definitely sort of just sort of reiterating what Elke said is clients have become a bit more fee sensitive. And I think, you know, go back to sort of the early 2000s, you could put your client in one of the big balanced funds, be it a Cora balanced, Allen Gray balanced, Investec managed, or even Cloud's Opportunity Fund. And you could easily sort of generate a 12 to 15% return with sort of, so clients weren't fee sensitive. I mean, it was easy in those days. And the bottom line is with low performance and low returns, and clients saying, but, you know, as clients have become sort of more knowledgeable, saying, well, after costs, I mean, my returns are poor. So as advisors, we've had to look for solutions that can generate both returns at a low cost. And I think with media and people having more access to information, and even sort of like passive companies like 10X advertising aggressively, trying to cut out the advisor, you know, people are asking questions, but why am I not in a passive fund, or why don't I go straight to a 10X offering? So as advisors, we've had to sort of up our game. I mean, that's the bottom line, cut costs where we can, and seek better performance at lower costs.
Thank you. Thanks for that, Quentin. It's actually so interesting. So if you think about how passive has actually developed in South Africa itself over the last number of years, but still, I think we're quite behind the curve when it comes to passive products in the developed world. So if you think about passive products in South Africa and what's available to you, if you had a magic wand, what is the one thing that's missing for you? What would you love to have as part of that toolkit? What would make your life as an advisor easier? I don't know, Quentin, if you want to.
I'll go, yeah. So definitely having passives in the sort of the fixed income space. You know, typically we run some cautious sort of solutions for those risk-averse clients, and there aren't really many passives or opportunities in that, you know, in that space. So I'd say to have passives in the fixed income bond market area, that would help.
Elke, would you agree with that?
Yes, definitely. I mean, I think it's very difficult for us because we really do have a small market, I think, compared to sort of globally what's available. So I think it is difficult to have or to create solutions like you do get abroad. But yes, definitely that would.
Okay, guys, so let's turn our attention to clients for a little bit. So how do we make sure that the value that you as an advisor adds are aligned to what the client wants or what the client expects? So if you think about that at the onset of the relationship, I know, Alka, you've got a smaller client base. Quentin, you've got this large client base. You have this initial meetings with clients. How do you define those expectations up front? Give us a practical example of how that conversation goes. Alka, I'm going to give this one to you first.
Thanks, Deborah. Yeah, I mean, this is something we've been working on for years, because I think what we realized over the years is that this is exactly where I think where relationships can fall flat between advisors and clients. Because I do think that, you know, where you think you add value and where your client thinks you add value can sometimes not be aligned. And I see this, I saw this typically. So we don't, I mean, I'm not saying that it's wrong, but we don't necessarily believe that we add much value by selecting funds for our clients. But your client might think that that's your skill. That is where you add value, is you're a fund selector and maybe market timer. And if that's not aligned, you end up having to defend performance, and then the conversations just really become very difficult, and you find yourself constantly on the back foot, especially if you go through times where returns are low. So we have very deliberately tried to state out upfront exactly what our process is, what it entails to go through our process, what clients can expect from us, and in some ways what we expect from our clients. And so we engage all of this right up front in sort of an introduction meeting. And you'll find, I mean, it's really difficult to do sometimes, but you will find that for some people, it's not something that they want to go through, and it's perhaps not something that they want to do. Or they maybe their values are not that much aligned with yours. And that's fine, and then we part ways. But at least up front, it's already defined and it's very clear, and it's really worked very well for us. I just want to add to that lastly quickly is I think also if you're going to do this, you also need to be very clear on what type of client you want. I think that will also help you narrow down the process.
Absolutely, and it's better to walk away at the start before the relationship actually has started, as opposed to a couple of years down the line, and you realize that we're never going to solve this misalignment between the practice or the financial advisor and the client. So sometimes better to walk away before the relationship even started.
Yeah, because if those things are aligned and you go through a difficult time, you don't have to defend yourself.
Exactly.
And, you know, we found over the years that rather walking away from one or two relationships, but taking on the relationships that really understand what you do and how you do it is worth so much more. I mean, it's difficult and it takes longer to build a business that way, but I think it's more sustainable.
It's more sustainable, exactly. So let's chat about the attributes of a financial advisor. So every advisor believes that he or she has something to bring to the table. Obviously, we won't be in this business if we didn't, and that you can add value in your client's life at the end of the day. So next up, I want to share my slides because I want to do a little bit of an exercise with you guys. I'm assuming you guys can see my slides over here. Okay, so most of you on the call actually know that Morningstar has an intense passion for research. We've got a passion for understanding investments, and even more so, we've got a passion for understanding and unpacking human behavior. So we've got a team of behavioral experts. They're based in the US, and they've done a study on this. The attributes of what an advisor ranks as the most important attributes versus what investors think the best or the most important attributes of a financial advisor is. So Alka and Quentin, I wanted you guys to, for everyone on the call, my panelists have not seen this list before, so I have to give them just a few minutes to look for it. If you look at this list real quick, and you think about what are the attributes that you think your clients will value the most. And So let's give you a few minutes. For the advisors on the call, please feel free to join in, make your picks. Is it the fact that you have a lot of experience and knowledge? Is it the fact that you communicate well? Do you have the relevant skills and knowledge? Is it that you always act in a professional manner? Is it that you use up-to-date technology? Jot that down real quick. And you can let me know if you have your answers. Quentin, are you ready?
Yeah, so I think even like, I think even the way Ilke's previous question and answering, I mean, all of these and above, but I'll give you mine. I think a lot of it, and the one thing that should be right at the top, which is number 0, is trust. Effectively, clients would like sort of come to us as a referral. We don't advertise. It's word of mouth, it's referral. And effectively, I think, to be honest, clients, there's a reason they come to you. They have no knowledge themselves about financial markets and products. So they just want to know that they can trust you, and they want you to be their coach, and to really sort of help them stay in control of their emotions. Number 1 is important. And they just want to know that you are giving them unbiased, independent advice, and that they can trust you. And that is the biggest thing. It's all about we in the trust game. And it's quite interesting, you know, like in my 24 years, Ilke runs a fantastic business, and she's a great financial advisor, but I've never competed against her, and I've never had an unhappy client come from Ilke and say, I'm not happy. We don't compete against one another. We compete against those insurance companies where clients have had bad experiences, products are not transparent, they've got no idea on fees and performance. So the clients that come to us, sort of, they want to know that, obviously want to know that you're professional and you're qualified and you've got the skill set, but it's all about, it's the trust and it's coaching them over time to reach their financial goals. That's what they want.
Okay, your view? Your top 3?
Yeah, I know this is a trick question, as you said. Like, I know what we think is most important is not necessarily what I think is most important.
Let's
I mean, I agree with Quentin. I think obviously the coaching element is really important, but I don't think clients like to know that that is what you're doing with them. I don't think they like to know that they're being coached. I think that's something that you would need to do well, but it's maybe not something you would say necessarily you're doing. And I agree with Quentin. I think it's the basic stuff. So I think it's things like understanding the fees, as he said, and understanding your financial goals and reaching your financial goals. It's probably also returns to some extent. Yeah, so I mean, for us, the emotional stuff and the coaching stuff, I think we know in the back end is super important, but I don't know if the clients will rank it like that. So I'd say the fees, the financial goals, and the performance.
Fantastic. Okay. So this next slide ranks the research that Morningstar has done across the globe, talking to advisors and what they think is important to clients and what they'll attach value to that. So first and foremost, to understand the unique goals, to help them reach financial goals, and then to give unbiased advice, which Quentin, you actually made mention of that. So it looks to me like more or less aligned there. What ranked the least, and I didn't ask you guys what ranked the least, but with Morningstar research, what we found out is that advisors don't think investors actually add any value in using up-to-date technology. So it's a lot more about the human interaction. And that, I think, Elke, you've made mention of that as well. Can help me maximize my returns. For me, it actually filters into help you reach your financial goals. So it ranked quite low, but in my mind, it's actually almost exactly the same thing. So now I think the question really here is what investors actually value. So now Morningstar took a sample of investors across the globe, so from different backgrounds, different demographics, different countries, different levels of wealth, different levels of income, different industries. And they took a sample and they said, okay, as an investor, what attributes do you want in a financial advisor? And this is what it came up to. So the most important at the top, and both of you have actually mentioned that, to help me reach my financial goals, the most important for them. Secondly, have the relevant skills and knowledge. And I think with that also comes an element of trust, as Quentin has mentioned. And then communicate and explain financial concepts well was the third one. What was interesting, what ranked quite low, and similar to what on the advisor side, is use the up-to-date tech. And then lastly, help me to stay in control of emotions. And Alka, I think you summarized that very, very nicely. That's what you're supposed to do. And I think investors actually want that, but you can't explicitly actually say that, because no one wants someone else to be in control of their emotions. So I don't know if you guys have any thoughts on this, but I think I've got about 3 takeouts, so maybe I should jump into my takeouts, and then let's have a look and discuss that further. So the first takeout I've got from this is that there is generally a misalignment. And Alka, you said it perfectly as well. So what investors actually value and what advisors think investors value sometimes are out of sync. And that's why it's so incredibly important at the onset of the relationship to define what are my expectations and rather walk away if the expectations are not aligned. Okay. And make sure that initially you as an advisor, you can make sure that those expectations are effectively communicated, so you don't have a conversation 3 or 4 years down the line and you have to walk away there. And then the second takeout here is that I think that goals matter, both from both parties involved. So from the investor point of view and from the advisor point of view. So in my mind, absolutely no misalignment there. There's no misunderstanding. Reaching financial goals is one of the most important reasons why we're in this industry. A good amount of time should be spent on making that happen. Then I've got a third takeout here, is that behavioral coaching sometimes is very misunderstood. And it's interesting for me that both of you actually mentioned that is incredibly important. When you talk to advisors across the globe, that actually didn't rank it that highly. But the modern financial advisor, I think, is very important. They're also a behavioral coach. So someone that helps to stay the course. And the research that we've done is actually, there's a huge amount of value that can be added by staying the course and having an advisor to help you stay the course. The research suggests, and we call it gamma, that value of financial advice is 150 basis points per annum. So that is a big number if you compound it over a number of years. And we all know, and I think Quentin, Alka, you can agree with me, emotions are our worst possible enemies. So you do need that guidance from a behavioral coach or a modern financial advisor to stay the course. I don't know if you guys have any thoughts on the slides before I jump in.
I think, Deborah, sorry, with one of the sort of the top points was communicating financial concepts in an easy and understandable manner. I think that is very, very important. And I think that's where a lot of possibly your younger advisors that are very technical, they've got all the skills, but they don't know how to talk to the end user, which is the client. And I mean, I always say to people, our clients are not asset managers or economists. I mean, our clients are grannies and grandpas or doctors or lawyers from other industries. And they sort of have they've got a general idea, but they don't quite understand. And I remember many, many years ago where I was fortunate enough, I was given a client from an older advisor, and when I sat with this client, one of the comments she made to me afterwards was, "Thank you so much for presenting in a manner that I can understand." And she really liked the previous advisor, but she just felt he was way too technical, and people are often intimidated. So if they don't understand, they'll rather say nothing or not ask questions because they don't want sort of to feel intimidated or the person think that they're stupid or don't understand. So communication is important in a very simple, clear manner, that you get your point across, and that the client must understand, and that sort of gives them comfort that you understand them and then they understand the product, which makes the whole process a lot easier.
Quentin, that's a very, very good point. And I think a lot of fund managers and a lot of advisors do make the mistake of thinking that the more technical I am, the smarter I come across, and the more clients will be intrigued or the more they would like it. But in fact, it's actually exactly the opposite. So being able to explain things in a very simple manner is a very important skill that every advisor needs to be aware of. So now we spoke about this misalignment, but now and emotions and being an emotional coach, How have you guys kept your clients invested in 2020? We come out of a year that was just unprecedented. And practically, how did you guys do that? Alka?
Yeah, I mean, Deborah, I think it was hard for everyone, including us. But I think for us, what really worked was clear communication. I mean, we made sure that we communicate often, and you know, we spoke to all our clients, we communicated regularly, we communicated very clearly. And I do think, I just want to touch on this behavioral thing, because I also think it links with Quentin's, like, speaking in a manner that people understand. I think it's all part of this behavioral kind of coaching skill thing, and the industry loves to call it sort of these soft skills, but it's really not a soft skill. I think it is an incredibly difficult skill. We in our team have been doing a lot of behavioral coaching courses, and I myself am doing a fully fledged accredited coaching course through UCT. And the reason I'm doing this is not because I want to be a life coach. It's just because I realize how incredibly difficult this skill is. And it's something that needs to be learned. And it's something that we need to, I think, make time for, because it's not as easy as we think. And so we have been upskilling ourselves in our business in this area a lot. And I can see how much it helped us last year with having those conversations with clients, because it was really often just about listening to someone and trying to understand what it is that they're going through, and rather than just jumping in and trying to give advice.
Yes, absolutely. And Quentin,
yes.
I mean, advisors are human beings. We're all human beings in this industry as well.
Yes.
We all go to Bryce. We also talk to our friends. We also listen to the news. We also get caught up in the noise. It's very difficult not to. Just human at the end of the day. So how do you give advice to someone to remain invested and say the cause of you yourself are becoming uncertain about that?
Yeah, well, I was quite lucky. I invested money on the 20th of March.
Fabulous.
And that's just following good old-fashioned advice of Warren Buffett. You know, the old saying, you guys always know it, you should be buying when everybody else is crying, and you should be yelling when everybody else is selling. And just that's almost like two ways to answer that sort of question and the previous question. We actually were very lucky. 2020, we had our best financial year, or best sort of new assets ever in our 17 years of business. And in very simple terms, I think what we've been able to get right is, from the outset, we've communicated regularly with our clients. We've coached them about long-term investing, stay in the course, all the Morningstar stuff and the Warren Buffett stuff. And as I always say to clients, I don't sort of mean to repeat myself, but every single time we do a review, we basically take them through a couple slides, and we keep reminding them, because markets go up and down, and we show them, there's an incredible slide by Vanguard where it shows out of 119 years, there have been 103 positive bull markets. There's only been a small amount, 16 years, where there were bear markets, and the average bear market's about 1.7 years in duration, where the bull market's 7.9 years in duration. So the big point is to coach your clients, remind them all the time about the benefits of long-term investing, and to sort of show them visual, because pictures tell 1,000 words. And on top of that, we communicate regularly. We send a newsletter monthly. We do a portfolio snapshot monthly, so they see the returns all the time. But obviously, you do want to communicate more when times are rough. You need to reach out to your clients, not run away. So I think that's where some mistakes advisors make, is when they're almost too scared to go back to the client to say that there's actually the portfolio is down. You actually need to communicate with them and just reassure them. And then from a personal perspective, you know, we all are human beings. But I think it's experience. I mean, that does help. I mean, you know, I'm quite a different person than I was when I started 24 years ago. And I wish I had sort of, when I started, had the courage to invest more aggressively when the markets were selling. But now, being there, done that, and seen that, I actually look for an opportunity. As I'll repeating Warren Buffett again, he says, every 10 years or so, the market rains opportunities, and you've got to run outside with buckets, not teaspoons. So we actually, on the 20th of March, we sent an email out to our client, and it was an article from Rob Armitage from Anchor Capital. And he basically said, he doesn't know how far the market's going to fall, but at these levels, the market's cheap. And we actually communicated with our clients. We actually called our clients who were sitting with cash, and we said, guys, this is an opportunity. And we actually attracted a lot of money where people say, actually, we understand this, and they invested, and hence we had an incredible year. So communication is key. That's the bottom line.
That is fantastic, Quinton. It's so refreshing to hear businesses that has actually flourished in 2020, where other industries had such a difficult time. I want to talk. The last section I want to talk about is a little bit about investments. Quite intimidating. I mean, if you look across the amount of funds, the products available, tax implications, guaranteed products, list goes on. How do you, as an advisor, keep up with that? So, Alka, do you have any tips for the guys on the call how to stay abreast of what's happening?
Yeah. I mean, so I didn't mention, I mean, Foundation's 9 years old now this year, and we just turned 9. But I've been in the industry 16 years, and prior to starting Foundation, I was in the stockbroking world and was a portfolio manager. So when we started Foundation, we very, very deliberately wanted to spend more time with our clients, and we realized that we wanted to change our conversations that we were having with clients. And we realized that trying to stay on top of all of this is absolutely a full-time job. So we do make use of discretionary fund managers, DFMs. We've been doing it right from the start since we started our business. And it is incredible. You know, we used to have conversations with clients about whether we should reduce the Sasol position to increase Anglos. You know, the conversation has changed completely. Of course, we try to stay on top of everything, but handing it over and making use of specialists to help us with these solutions has been absolutely the best thing we've done. Because, I also, what really drove home for me with this was, sometimes you're sitting with a guy and you're talking to him about, I don't know, as I say, some share, Nasbash, and this person is actually going through a divorce, or, his spouse has got a gambling problem, or there's other big stuff going on in their lives, and you don't even get there because you're so focused on the investments and the fund selections and the performance. So we very deliberately made a decision to kind of step back and make use of DFMs to support us in this area. And so that's been our approach.
It's very interesting. Thanks, Alka. It's a nice perspective as well, as we get so caught up in the little things and we actually forget to ask the clients, what do you care about, and what's the big things and the big boulders for you at this point in day and age. And you've mentioned now about DFMs. It's interesting, DFMs, over the last couple of years, we know the rise in DFMs in this industry. Each DFM that you talk to and that you a client of, they've each got a different, something different to them, a unique role in each and everyone's practice. So Alka, I think you mentioned it now, so separating that investment decision from the financial advice. So Quinton, is that something that you see as two separate decisions as well? So you've got the advice side and then you've got the investment side on the other side of the table. Yeah,
I mean, most definitely, and sort of all these questions are sort of iterated, and definitely sort of like the DFM, and I say, like, going back to Elke's sort of answer, I think you can't be jack of all trade, master of none. So you also, there's too many companies, too many funds. It's better to partner with, I would say, sort of fewer companies and rather sort of understand those well. Definitely the DFM is a game changer to let them do the research. And then I think also investing in your own business is for having internal people that can help research, look at the different competitors, because you don't want to be completely sort of like a horse with blinkers on that you don't know what's going on. But yes, but definitely from the advice side and the investment side, they are completely sort of different things. And I think the role also for the DFM from a business perspective is very important, because as a business and sort of as a business owner, you run the risk that as you take on other advisors and grow your company, you need your advisors all to be aligned, using the same products, using the same house view, using the same portfolios, because there's a massive risk, and the clients need to be treated fairly. They all need to be getting the same advice. But as a business owner, you need to make sure that you are protected, because if you're challenged on how did you make a decision, I mean, the bottom line, the client will go past the advisor, come straight to the sort of the directors and say, but you employ that representative, and why is he outside of your house view, and actually challenge you. And there's massive risks. And it's important for the clients. I mean, the clients, they're not treated equally. There'll be power sort of efficiencies from a passing perspective. And I just think you can then focus more on managing the client and the relationships, and focus on the advice, as opposed to sort of worrying too much about the underlying fund management and picking funds. And the game has changed. I mean, back in my day, you could pick a handful of companies and they only offered a handful of funds. So it wasn't too difficult to pick sort of 3 or 4 funds out of 20. Now there's 1,600 funds plus, and every month there's more.
Yeah, hard to keep up with all of that.
Yeah.
Quentin, so you mentioned a lot of the benefits of having sort of the model portfolios and having a DFM looking after investment decision, the efficiencies, the cost aspect, the house view, the compliance together with that. But I want to actually now, I want us to launch a poll, and I actually want to ask the audience real quick about just high level, what is your view on a DFM? So I'm going to ask Michelle to launch the poll for us, and I want everyone just take a second and vote. What is your view on DFMs? So first of all, as a DFM simplified my life and practice to a great degree. I don't really know what a DFM does. I don't know if I would qualify to be considered by a DFM. And then lastly, I don't see the value of a DFM. So let's see, give it a minute or so, and then let's see what the audience has to say. Just a reminder to everyone on the call, if you do have questions for Alco or Quentin, please send them our way. We're going to have about 5 minutes left for questions at the end. Okay. Got a few more people that needs to vote. Okay, I think let's wrap it up. I think that's, there you go. Okay, so a DFM has simplified my life. I think that's the majority of the audience. Agrees with what Quentin and Alka just said, about 62%. I don't really know what a DFM does, 16% of the audience. I don't know if I would qualify to be considered, 12%. I don't see the value, 10%. Quentin, do you have anything to add to this? Any thoughts?
Yeah, I think so. From just talking from our business perspective, going the model portfolio and DFM route, as it was a game changer. It allowed us to follow, and does allow us to follow, a professional approach that, we say to people, most advisors out there are not portfolio managers, economists. And I think we also need to be realistic of where our skill set lies. And using a DFM is, from a asset allocation, a portfolio management perspective, has been a game changer. Far more efficient. Performances have dramatically improved, but it also allows you to manage clients more efficiently, because when we have a quarterly meeting with Morningstar, and if we need to make changes, clients across the board get switched. For example, we might be including emerging markets into our portfolio, and it's impossible to manage clients if you have to physically run around, or contact, or phone, or fax, or whatever it may be that you use. Trying to get clients to sign switch forms is not efficient. It is impossible. So it does sort of a DFM and a model portfolio. It does really, really add value, and it does work. It's good for us.
Great. Okay, guys. So I think let's wrap this up here, and then I'm going to go to the audience, and then we're going to start with questions. So I think from our discussion, there's 3 things for me that actually stood out. So the first one was around passives, when we started the conversation about passive, the role of passives in a portfolio. If it's used against or alongside very good active managers, it can be a very powerful tool in portfolio construction. It lowers the cost in the portfolio. It brings an element of predictability. It's transparent. And both of you guys make use of passive solutions on the local front as well as on the global front. On the local side, both of you have said that on the fixed income side, maybe there should be a little bit more passive options for clients to consider. And then the second thing that came out for me is that DFMs do play an incredibly important role in terms of building these portfolios, making sure about the investment decision and the research to back that. They play a huge role in freeing up the time of the advisor to make sure that you guys focus on what you do best, and that's providing financial advice, which is often quite different than what the actual investment decision is. And Elke mentioned that a couple of times around the behavioral aspect. And I think the third thing for me is that the most important feature in this whole puzzle, in this picture, is at the end of the day, that advisor. Keeping clients invested, keeping them aligned with their long-term financial goals, and ensuring that they stay the course, and ensuring that those investment returns that are generated are in sync with the investor's return at the end of the day. So I think for me, that's basically the three key takeouts for me. So ladies and gentlemen, so let's kick off with some questions. I'm seeing some questions coming through. I want to tackle one quickly that came through the registration process first. So Quentin, I'm actually going to give this one to you because you've been in the industry a little bit longer. What would your advice be to youngsters wanting to get into the industry? It's just a difficult environment to get into these days.
Yeah.
Difficult to build a book. How do you get youngsters excited about financial advice? You've got a young staff complement. How do you keep them motivated?
Yeah, I think I also talk about it from a business perspective. I think it's very, very hard for young financial advisors to get into the industry. And why I say that is, typically, if the guys, most youngsters typically look to the sort of the shiny stars, like everybody wants to work in the young, or the 91s or Coronations, Allen Greys. It is becoming more and more difficult to get into those sort of corporates. From a financial advisory practice, it's actually interesting, the statistics say that 1 in 5 young graduates actually succeed. And that is the hard part, because for a financial planning practice, to hire a graduate comes at a cost. Effectively, you need to pay them salaries. And it typically, sort of in my experience, I've had a couple that have succeeded and a couple that haven't succeeded. And typically it takes the youngsters a minimum of 3 years that I've seen to actually build up a decent size sort of asset base or client base. And it takes them approximately at least 3 to 5 years to break even. So as the practice, you've outlaid a cost for the last sort of 3 to 5 years, sort of supporting them and coaching them. And it'll take you a long time to ever recover your money. So financial planning practices, they're a bit nervous of taking on too many graduates. So for those graduates, and given sort of we are competing in a shrinking client base, for youngsters, it's very much a case of not what you know, it's going to be who you know to get that opportunity. I would say if you're fortunate enough to get the opportunity to join a financial planning practice, I'm old school, and I always will be old school. You've got to work hard and smart. I mean, the youngsters typically is work smart, but you've got to work hard and smart. You've got to show your value. Sort of first in, last out is sort of my mantra. And if you get that opportunity, you better grab it with both hands, because there are millions of kids behind you wanting that one opportunity. And that's my advice.
Thank you. Thanks so much, Quentin. I see we're almost running out of time. There's one question that came through around DFMs, and then actually the experience of those advisors that DFMs are not keen to add passive into portfolios. I'll quickly tackle that question, and then let's wrap up. So I can't speak for other DFMs. From a Morningstar point of view, we very much think that passive does play a role in the portfolio. And as Vicky said in the previous session, that you never should look at passive and active as being mutually exclusive. They actually work alongside each other. So from a Morningstar point of view, that's definitely not the case. Okay, so I'm going to end this off here. Quentin, thank you so much. It's a pleasure to have both of you. Michelle, I'm gonna give it back to you for the last little bit of housekeeping. Thanks so much.
Yes, thank you so very much, Deborah, Quentin, and Alka. I really enjoyed listening to that. There's one question here on fees. So perhaps, Deborah, you can reply to that by email and send them some details on the Morningstar fees. And another question about the difference between someone running a multi-asset fund and a DFM, which I think is worth flagging the difference. So a multi-asset fund would be, we as CoreShares have some of our own multi-asset funds. So we set the asset allocation and choose the building blocks for that. Whereas what a DFM does is they have their own asset allocation, and then they go to the whole market and choose the building blocks and the funds that they want to put into that. So I think that's an interesting distinction. So obviously the DFM is more objective. They have the view of the whole market, whereas the multi-asset fund is the fund manager's own asset allocation and building blocks. If you have any other questions, please feel free to send them over email and one of us will get back to you. Remember to stay online to put in your CPD points, so put in your ID number to get your CPD points, and you'll get the recording of the session afterwards via email. So thanks again very much for joining us, and to our wonderful panel members, I really enjoyed that.
Thank you.
Thanks so much, Michelle.
Thanks, everyone.
Cheers, guys.
Bye.